I define myself primarily, I get involved in different aspects of the trading business. I trade for my own account. I may be one of the few advisors that actually walks the walk, writer, lecturer, etc. What I consider myself mainly to be is a researcher. That's how I spend an overwhelming portion of my waking hours. Looking for ideas, refining existing ideas, and we're talking mechanical trading. Okay. My career can be broken into two distinct parts. All my triumphs have come from mechanical trading, without any decision-making whatsoever, off programs that tell you exactly when to be a buyer, a short seller, where to get out, etc., etc. Nothing more. Now, because my aggregate triumphs have come almost exclusively from 100% mechanical trading, and trading I've engaged in has been near inevitably disastrous, I am an advocate of 100% deviation-free, exception-free, plain-free mechanical trading. It's the constant theme in my practice. So today I'm going to show you a particular aspect about system development. In the course of this demonstration, you'll hopefully understand why you haven't been able to trade, why mechanical trading will probably be a good alternative for you, what makes a good mechanical system, and then the crux of the presentation, how you have to weigh and balance many considerations in building a system, and finally determining the best measure. It's a standard adage in this industry that 90 to 95% transfers money to the remaining minority. That's kind of anecdotal, you know, as someone that likes to see proof of everything before I act. I'm willing to accept it anyway, just based on my personal anecdotal experience. Trading or the Board of Trade, I've seen people come and go like a revolving door. That's probably a very accurate stat. Most people are neither systematic nor mechanical and trade according to whatever whim strikes their fancy at the moment. They trade according to good, all right? So since most people lose money and most people are trading according to whatever feels good, it stands to reason logically that instant psychological gratification is going in the typical trader loser pool. So as one luminary out there said, what you really want to do is the hard thing, as counterintuitive as that may sound. The problem with our wiring, okay, and it comes down, as they've done studies, and people are resistant to taking losses, but they're very quick to take profits. And, you know, if you're listening to this, you've heard a million times, cut your losses, let your profits run, and, you know, in the calm of an off-market hour lecture room or something, I'm sure we all agree on that. But when you're in the heat of battle, that's easier said than done, because we've seen so many times a decent profit gets away from us, okay? And we've seen other examples of where a big loss comes and rescues us. Well, these are bad examples to follow. You know, the thing about trading is good decisions don't necessarily reward you. Bad ones don't necessarily punish you. It's going to work out in a way that you don't want to follow overall. The other thing is people attempt to impose order where there is none. You know, look at your charts. Everybody that's done any kind of technical trading has seen the classic tech sample shoulders, tops, and bottoms. They work beautifully when they get you know, the end of a move. But what you have to notice if you're a hard-nosed mechanical system developer is that there's many times where they're actually forming in what winds up being the middle of a move. And sometimes those are apparent, even in the examples. But our go to what makes us feel good and gloss over or ignore what doesn't. So objectivity. Objectivity is, you know, the name of the game. Painful objectivity. Okay. Most people lose of the only reason to trade. Trading can be a lot of fun, but if it's a lot of fun, you're probably doing it wrong. Trading can be serving some sort of psychological need to prove yourself or to, you know, validate yourself somehow. There's only one reason to trade, and that's to make money. Okay? At the end of the day, the end of a sufficiently lengthy series of days, I should say, must not make anything. If you're up, you know, you're accomplishing what you intend to accomplish. If you're down, you're not. A lot of things that will make you a loser. Now here's something I can vouch for because it's happened to me over and over and over again. Trades people fear the most tend to pay off the most. It's the idea of, I don't care what the system is saying, this cannot work. Well, guess what? That's where your windfall is coming from. You know, Black Monday, I came in correct in the stock market, but I also had a bond position on that was long. And, you know, that started out being a loser. Well, everything's falling apart. Why are bonds going to rally? I hadn't, at that time, been into accept the flight to quality. Well, suddenly, you know, my bond position was locked up, favor. So, luckily, I followed that. Biggest problem areas arise in trades in which people are the most comfortable, complacent, and confident. You know, I've written a whole book on that subject. It's called Super Traders Meet Kryptonite. And it's a book about prominent traders who took horrendous losses that most of us are never even going to dream of, let alone, you know, suffer through. And they triumphed and got beyond it and went to new heights as traders. And there's just a lot of commonalities among the scenarios, among all these traders, and one of them is that these horrendous losing sessions tended to come on the tail end of a series of humongous wins. It's a period in which the traders describe themselves with a variety of adjectives. They were able to walk on water, they were bulletproof. They got careless. That was almost way from then on, and easygoing, and why did they ever stress over anything? Well, boom. You know, that's when the floor fell out from under them. Now, mechanical trading will bypass all these ups and downs that I've been talking about if, you know, you let the system just run. If you've tested correctly, you've invented a moneymaker, and your job is to just turn it on and follow it exactly. So it bypasses emotion and our natural psychological wiring. Makes it possible for us to be in that 5 to 10% winners. It imposes, this is something else extremely important, okay? If you're trading according to whatever whim strikes your fancy, you can't you can't really draw any conclusions that are going to power you forward into the future. You know, people on games all the time, okay? I took this trade because I didn't see that the bonds were firm direction. I took this trade because I failed to notice that it broke this resistance line on whatever. Okay, next time I'll do better. Well, next time they got a different reason. And it's just a constant changing of reasons and justifications. And that's far more comfortable to do that sort of thing, because if you're trading on a system, they have a hard and fast blueprint. There may come a time where you have to face that perhaps workable after all. Perhaps you did something wrong in your testing. And that's tough, because you've invested a lot of emotion into it, a lot of time, a lot of work. And maybe you've lost a lot of money. But, you know, there's a point where it's more prudent to spend good money after bad. And that's what a mechanical system is going to do for you, because it's all out there, you know, what your worst series of losses look like, what your worst drawdown looks like. You've got a roadmap that you wouldn't have if it was just the guts. And so that's what is meant by imposing accountability of yourself. You can't play games with what the results are that you have right in front of you. All right, now, the difference between a discretionary trader and a mechanical trader is the discretionary trader will concerned with the trade in progress, massaging the trade that is ongoing. Do we squeeze a little more profit out of this, or do we take it right here? What about the losses? Where do we cry uncle? Mechanical trader, on the other hand, is only interested in a vast of trade. He knows that there's going to be losses. You know, that L column is just doing business, just like somebody else's cost of doing business might be inventory. Ours is losses. And it doesn't really matter. In fact, that's going to be the gist of this lecture. People get hung up on individual aspects of performance, you know, like what's your best percentage profit or this or that. It really comes down to everything together. The numbers game you've created. Is it profitable, somewhat consistently profitable, or is it not? The model for a numbers game, of course, is Las Vegas. Somebody may be getting hot at table 6 over there. Somebody may be getting hot over there or over there. Short-term gains, that's good for Vegas too. You know, you've got to have some sort of word of mouth that there is a possibility that you're going to make money. But overall, they're not worried, because the edges have been built into the games. You play the pass side in craps. There's just more ways to 7 out. Don't pass side, they'll let you play that too, even though you're roughly playing the house game. They don't pay you on a come out 12. So, I mean, whatever they do, they flies and reverse any edge that you might have. I don't know that machine. They're controlling every roll. No problem paying out $200,000 if the rolls leading into it have collected $500,000. And I want to say one more thing about the numbers game. There's a lot of components to it. Number of trades, number of trials, I should say, if we're talking Vegas. Average amount you're collecting per trial. You add them all together, and the only thing that really matters is the totality of it. Now, let me illustrate what I'm trying to say here with the strategy in front of you. Okay, I want everyone to understand that I'm not giving this away. That's not the point This is, think of it as a model that we're using to demonstrate an overall concept that be very helpful in your own system building. This is a intraday system that works in the 5 major markets that are related to the stock market: S&P, NASDAQ, Dow, Russell, Midcap. These are all mini contracts, and it reflects a result off of one mini contract, each trade docked $5 for slippage commission. And the field of study is from the beginning of 2005, ending January 7th of 2015. Okay, now you see that the system holds up in every one of the markets, not a losing market in there. You notice in the column under trades that you have a lot of trades, thousands of them, which should make us pretty confident that this is not a statistical fluke. The average trade you see in the third column is over and above the $5 slippage commission penalty. Reasonable. This is where some people get hung up, the next column. Questions that I get at the end of speeches almost inevitably contain one or two where I'm being asked, what percentage profit do I strive for? Well, as you can see here, it's pretty much around the 40% mark. Now, what I want to demonstrate today is why one aspect of your performance summary does not really tell much of a story at all. It's all together, okay? But I'm getting a little ahead of myself. Look to the next column there, maximum drawdown. What that column tells you is what your worst loss was, or a series of losses, from a high point in your equity. If you have a winning system, you know, periodically your account is going to move up to new highs, but then inevitably it's going to draw back as losses hit. So from that high that we're talking about to what winds up being the lowest point before the account then resumes and takes out that high and makes a new one, which can only be determined after the fact. But that point from that first high to the subsequent lowest low is the worst drawdown. So all popular trading software will give you that figure. And good rule of thumb, by the way, under the assumption that your worst drawdown is always ahead of you, figure you're going to need enough to cover at least 1.5 times that drawdown when you're contemplating your bankroll. The last column there, ROA, stands for return on account. And that, all testing software will let you test for different elements, okay? It's not just best net profit necessarily. You could be testing for best percentage gains. You could be testing for best average trade, whatever. The return on account tells you not just what you made in the field, but what you made in relative terms, what kind of pain you had to go through to get there. And it's computed by assuming that your startup capital was your drawdown amount. So in the top example there, S&P's, it assumes you started with $6,448, and the subsequent $47,617 profit was a percentage return of 738. Okay, so it's the net profit divided by the max drawdown. That gives you a percentage that your account would have increased had you started with the max drawdown amount. I'd argue these are impressive figures. And no, it doesn't bother me that the percent profit is like around 40% or under. If you were doing a straight trend following system, which some big traders out there, that was their whole bread and butter. You know, you're looking at maybe a third winners, but the profits are so much bigger than the losses. That's how they were able to amass fortunes. So I get frequent questions, you know, what am I shooting for on percent profit? And, you know, I'm of the school, there are no such things as stupid questions, particularly if you're not living in the research lab all the time like I am. But I guess in my head it's kind of a puzzling question because, again, I don't care how we arrive at the profitable numbers game. I don't care if it's that the winning trades are bigger than the losses, or that there's more of the winning trades, or whatever. It's the totality that's all that matters to me. But I'm not unsympathetic. We tend to be nervous as traders, and we like validation. We like reassurance that we're on the right track. So all things equal, something that rewards you more often rather than less is going to be preferable. Stands to reason. So let's say you're someone that just absolutely has to have a high percentage profitability. Okay, well, same system. Tweaked so that your profitability is 81%, 79, 81, 81, and 80. Have it your way, like they used to say at Burger King. So do we have a superior system now? This is what I want to demonstrate today. There's different ways of looking at it. You're happy with this? Just eyeball it for a second. How about when we look at the max drawdowns? Top box is the original system I presented here. Bottom is modified so that they're more there's a much higher profitability. Now look at the max drawdowns. It's double in the S&P, 1.5 times in the NASDAQ. Go to the bottom in the mid cap. You're at $29,000 versus the original $11,000. You can see a similar deterioration in the maximum losing trade columns. More than 3 times as much in the S&Ps and in the NASDAQ. Obviously, all things being equal, you prefer to have a smaller, largest losing trade than a larger one. And as for largest winning trade, obviously the opposite holds true. Now, again, it's possible to have a system where your winning trades are capped, and you need an awful lot of them to overcome the losses, but I'd be dubious about a system like that. At its extreme end, there's something called a martingale system, and that system is to just keep redoubling after a loss, so that you're going to get a string that presumably is going to end up with a winner. Well, I'll tell you, if your goal is to win yourself a free dinner in Vegas, but you're willing to put up your whole trip and then maybe then some to do it, you'll probably get away with the dinner until you do it enough times. I think you need relatively large, you need a potential for a large profit, because no matter what your percentage of wins is, and no matter how unlikely a loss is that you make it, a string of them is going to happen. And if you can't recover because your wins are paltry at best, and you're going to need a whole bunch of them to put together, you're going to be in trouble. I'd also take note that your average trade shrinks significantly in this example. So in short, this exercise of increasing your percentage of wins is hurting you both on your winning and your losing sides. It's making your ratio kind of the opposite of what you want to see. All right, for our next week, let's try to get the average profit per trade up. And you can see it's possible in the green at the bottom there. But at what cost? Well, your total number of trades shrink to the point where they're statistically unreliable. So we want to go the other way. We want more trades so we can feel more confident that, it's not a fluke. Well, more trades, less average trade, significantly less, to the point where we're knocking on that slippage commission door, barely exceeding that, right? The $5 per trade. So in short, something's got to give somewhere. If there is a portion of your performance summary that you want to key in on, you can improve it, but you're almost certainly going to give up something in some other area of that report. Higher percent profit equals quicker profit taking. The way we psychologically like it, phew, I'm out of the trade. It's not going to turn into a loser. Slower on the loss side. Slower to take the loss. Bigger loss, in other words. Excessively tight stops equals low percentage profit. The tighter your stops, the more often you're going to get stopped out, and that translates into more losing trades. Now, when you add qualifiers and filters, you make your trading rules more strict. You're obviously going to get less trades because less trades are going to meet the qualifier, and that's going to decrease your statistical reliability. More trades tend to equal less profit per trade. All right, so in summary, we tend to be wired opposite of what is needed for profitable trading. Namely, we tend to cut our profits short, tend to hold on to losers too long. Mechanical trading takes away the problem of human emotion and psychology. So you just basically need the will to run your money machine absolutely correctly without deviation. A single trading system can be tweaked to improve certain aspects of performance, but improvements in one criteria will be to the detriment criteria, almost inevitably. So, final summation, performance in its entirety is what is most important. And the return on account, ROA, is the best measure of a system's success. In just about any, there are some exceptions, but in the overwhelming number of system performance summaries that I utilize, that's what I'm testing for, return on account. Again, that's profit over a period of time in relative terms. All right. Thank you, everyone, for hanging with me. So, time for questions, right? Hello? If I'm supposed to be seeing the questions here, I'm not seeing them. I got a feeling somebody's talking to me and I'm not hearing it. Read? Okay. I found it. Yeah, I'm not even sure if these are for me. I'm sorry. I'm here. I'll give you out my personal email. How about that? Arthur Collins 1. It's Arthur Collins, ARTHURCOLLINS, the number 1, at Comcast.net. And I think you're going to be receiving some sort of message from Tiger Shark. If you don't get it, you might want to just go on that website, tigersharktrading.com. Okay.
Art?
Yes, I'm here.
Hi, apologies for that. Were you trying to get a hold of me?
Yeah, I wasn't seeing the questions. I thought maybe you were going to forward them to me.
I do apologize for that. Do you see the chat or the question?
I see some now. Yeah.
Okay, so that's going to be where all the questions are at right there.
Okay. How does ROI compare to ROA? ROI is an oscillator, and ROA is return on account. That measures performance in relative terms. ROI is an oversold, overbought indicator. Okay, the system in crude fashion measures what has happened in the last X number of bars, whether there's been more upside or downside pressure. Okay, and the tweaks involved have been just making the rules stricter, easier, etc., for the demonstration purposes. The system as it actually exists has a profit target that's twice as far away as the stop loss. So I'm getting like 39 to 40% return on that, but in theory, you would have expected about 33% if it was just blind chance. So I'm happy with that overperformance. This is for futures markets. Okay, the 5 major U.S. indexes: E-mini S&Ps, NASDAQ, Russell, Mid-Cap, and Dow. Okay, I see they have a different definition for ROI rather, that I wasn't aware of, return on investment. Okay. Okay, I would not count on this working in Forex, an answer to that question. My numbers are indeed based on trading one contract. Okay, how to avoid taking profits too quick and too small, that's always tempting, isn't it? Just have mechanical rules that prevent you from doing it and follow the rule. That's the best answer. Scroll up here a little bit. I'm sure I missed a bunch. This lecture is being recorded, I'm told, in answer to that question. Okay, with the number of trades executed each day, why is anyone being charged $5 per trade? All right, what the slippage commission idea is, first of all, you are going to pay a nominal commission, okay? Second, you can't figure on getting filled at the exact theoretical price that you're projecting. In other words, if you're saying that I will be buying an S&P contract if it goes up to 2179, let's say, there's no guarantee that you're not going to get filled at 2179.50 as the stop is hit and becomes a market order. So you have to build in, it's not an exact science, but you have to figure that there's going to be some stuff that comes back at you that is not the ideal projection. So that's why whenever you're playing with a system, you have to build in slippage commission. Admittedly, $5 slippage commission is probably too light. I go as high as 30 when I'm testing. I build in $15 for each entry and exit round trip. Okay. How do you find your trades? I brainstorm. I look at show me studies. I scroll through charts, and I'm just constantly asking what if questions. I'll look at something that has a big upside run, and I'll say, what happened prior to that? Was there anything that could be a tip-off? And I'll notice something, and then I'll go back in the trades that led up to it that had the same configuration and see if it worked that way prior. And then I run strategies through. I'm on the TradeStation platform, and it allows you to, program. It's a very easy programming system, by the way. If it weren't, I wouldn't be able to do it. And I just shoot formulas out. And, I wind up keeping one for about every 999 that don't work out. But that's fine. I got plenty of time. And, I mean, it's just the approach comes from many different angles, Maybe I'm keying in on some momentum idea. Or maybe I'm keying into, what happens near the opening price or the closing price, and so those are the most active time frames. Or are there other time frames that are significant, an hour before the close? I mean, just every question you can come up with, leads to, another 1,000 different questions. So, I mean, it's just, the best way to come up with a lot of ideas is just to love looking for the ideas. To just absolutely consider this, a big puzzle, and, people have tried to pull me bodily out of the room sometimes, but this is what I do. Good question. Forex, I'm not that familiar with. I'm really sorry. That's about all I see, folks. If you want to type some more in, or you want to go to my email address or whatever, again, arthurcollins1@comcast.net. Or you go directly to Tiger Shark.